Hello and welcome back to the Wall Street Petting Zoo. We've got another week of news for you. I am Chris Smith,
And I'm Robert Coburn.
and this week, Robert, we kicked off the week with reports that the trade deal that was announced last weekend that we discussed was not actually a done deal yet. China's vice premier was going to come back and kind of iron out the details, and so it kind of seemed like they had worked out some broad details, but they didn't have an actual deal yet. Um, Meanwhile, though, Trump announced that China had already started buying U.S. agricultural products in accordance with the deal. So there was a lot of indecision over this in the market Monday morning. We pulled back, then we moved ahead. It kind of seemed like investors didn't know what to make of all of this.
Yeah, it kind of confirmed what I found last week when I was like, well, it looks like the deal didn't really get confirmed. It was just kind of wishy-washy at best with the in terms of like what the details were with those. So kind of confirmed what I originally read. That
Yeah, you called that one. You
yeah.
did.
And
Well
then the,
done.
the market rallied in a big way Tuesday, nearing all-time highs after most of the banks reported their earnings on Tuesday. They probably would have done it Monday, but Monday is a bank holiday because of Columbus Day. And healthcare companies reported better than expected earnings. It was a low bar, though, because analysts have been setting their expectations low for banks. And they've been forecasting a third straight quarter of earnings decline in S&P 500, about 5% lower than the same quarter last year. The actual earnings picture is looking like it'll be about flat from the same quarter last year.
Yeah, so analysts have been pretty pessimistic, but we're doing better than expected. But it's not like the economy has grown since this time last year. So the stock market, though, is above where it was last year. We've been kind of going up and up and up on all of these optimistic headlines about a China trade deal, but a China trade deal has never actually materialized. So it seems like we've got a bit of an optimism bubble where that's concerned.
Yeah, and that's kind of scary because you kind of think that as soon as if China were to come back and say, no, we're not doing this at all, period, that a lot of stocks are going to tank on that. Well, not tank, but dip at least 10%.
Yeah, I think they could potentially tank, although surprisingly, the economy has done better than anyone expected in the middle of the trade war. So I don't necessarily think they would tank to the levels that they tanked to right after we initially got news of the trade war. But we'd get a pretty significant drop, I think, in the market if that happened. Definitely a risk. Um, Wednesday, the market went slightly red as Evans, a member of the Fed, the Federal Reserve, announced that earnings have been so good this week that the Fed won't need to cut interest rates again this year. We also had some data from the American Petroleum Institute on Wednesday showing that there was a huge accumulation in the U.S.'s oil inventory. And this seems to be because there's a Chinese shipping company called COSCO, and the U.S. slapped sanctions on that shipping company. And that shipping company is heavily involved in exporting oil from the United States. So the fact that we have sanctions on the shipping company means that we're not shipping as much oil out of the U.S. as we ordinarily would be. So all of that oil is just accumulating in the U.S.'s stockpile in warehouses. And a larger supply of oil in the U.S. means falling prices because, of course, the laws of supply and demand say that if demand holds steady and supply increases, prices fall. So this hurts oil and gas companies, and we saw that on Wednesday morning. But we went green again on news of a Brexit deal. Brexit is, Britain is leaving the EU, and it's been thought that they were going to just leave the EU without any kind of deal to work out trade agreements and taxes and so forth. But it seems like they're in the process of getting a deal signed and through Parliament, and that's great for oil stocks. A lot of oil stocks have exposure to UK markets and European markets, and so oil definitely rallied on that news. I actually bought oil on news of this crude inventory build. I bought an inverse oil fund, so I bet against oil on news of this inventory build. But I had to get out of that pretty quick because oil rallied on the Brexit news.
Yeah, and I'm not sure if you saw the news. There was also a fire at one of the refineries, coincidentally, uh, on Tuesday afternoon. There was so much smoke here in the Bay Area, because it kind of blew the smoke blew in from that area. It's near the Carquinez Bridge,
I
where
did
those
hear
oil
about that. That
tanks.
sounds awful, though.
Yeah, so the two of the tanks were destroyed, and they're kind of alluding it to being the earthquake that we had early Tuesday that may have caused that fire. Uh, but there's always that conspiracy theorist speculation that when oil prices are fluctuating, and then all of a sudden oil tanks explode, or an
Hmm.
accident at an oil refinery. But that's only if you enjoy conspiracy theories.
Well, you had the Iran tanker get bombed, and you had the Saudi Arabia oil field get blown up, and you could imagine a scenario where somebody who wants to make a lot of money off oil in the stock market is blowing things up.
Yeah.
Sure, why not?
And then one sort of overlooked piece of news from Thursday was that the Phase One deal with China sort of fell through when China said it would not purchase 50 billion of U.S. agricultural products unless the U.S. immediately repealed $50 billion worth of tariffs. Also, the House of Representatives passed a bill requiring an annual review of the Hong Kong situation, so it's looking less and less likely that we'll get a resolution of the U.S.-China trade war this month.
Yeah, definitely. We had some sort of pessimistic midweek news. On Friday, we saw tech stocks drop, and to some extent, that may have been because of that pessimism about the China trade deal. Netflix had been up slightly on its earnings report on Thursday, but it plummeted on Friday. And Facebook, Amazon, and Alphabet, the rest of those FANG stocks, as they're known, followed it down. We also had Boeing and Johnson down. Boeing being an airplane producer, and Johnson and Johnson being a pharmaceutical company. So that caused the Dow to sag. So that the Nasdaq led the way down. The Dow and S&P 500 were also down pretty significantly. Verizon went slightly up on news that they may be selling off the Huffington Post, with hundreds of layoffs already being announced on Wednesday. Huffington Post and other digital media providers have been struggling to find ways to make profits on digital news, so it's definitely a struggling industry there. So by offloading that segment of their business, Verizon has cut some costs and offloaded some risk. One thing that happened Friday that helps explain the drop was that China's GDP numbers came out. So in addition to trade war risk, we also had a weaker than expected Chinese economy. And the market reacted negatively to that because a weak Chinese economy means weak demand for U.S. technology products, which is why the tech sector was hurt more than others. But that weak GDP number also means that China is more motivated to sign a trade deal with Trump. And sure enough, last night, China's vice premier said that they were making substantial progress toward a phase one deal. I think the market will probably rally Monday on that news. But if you'll recall, we were already supposed to have a phase one deal in the bag last week. We've gone up this week, so it's hard to know how the market will react to this news of a phase one deal all over again. It's deja vu all over again.
Now, who said that the Chinese vice premier said that substantial progress? Was that Trump who said that?
No, this was a news agency reporting these comments by the Chinese vice premier.
Oh, okay. So it's
I agree with you that you have to be skeptical of optimistic comments from Trump, but it's a little more credible coming from the Chinese vice premier.
yeah. So how did your stock picks go from last week?
Yeah, so in addition to the ones that we discussed on the last episode, I picked up a couple things because I saw some news Sunday night. I saw that the new PlayStation 3 or PlayStation 5, was going to be out by Christmas. And I also saw that Google was scheduled to announce some new products on Tuesday. So I bought some Google stock and some Sony stock Monday morning. And those ones did really well for me this week. Google was already, 1% green on Monday, but then as soon as those product announcement happened, I think I gained like 3% in each of those, and then sold for some nice profits kind of midweek. My Monday morning purchase of Lockheed Martin and Raytheon that I discussed last episode, on news of the sending troops to Syria, and also news of the $12 million radar contract that Raytheon had gotten. Those made me a few percent early in the week. I also bought those or sold those for a quick profit. And also, Robert, after our last Zoo Tour episode, our educational episode from last week, when we noticed that the Russell 2000 was way cheaper than the S&P 500, and that it seemed to be at kind of like a support level relative to the S&P 500, I bought some of the Russell 2000. That's that small cap index fund. And that beat the S&P 500 for me this week. I'm up about 2% at the end of the week in that, about $1,500 worth of that. So that worked out pretty well for me. I also bought some gold Monday morning. As you recall, we saw gold at a trend line. It seemed like it was maybe about to break down on news that the Fed was doing quantitative easing, that the Fed is injecting more cash into the economy. So I bought some gold Monday morning, and the dollar did collapse like I predicted on our last episode. I actually got out of my gold a little bit too early, because when I saw that Evans from the Fed was saying there wouldn't be another rate cut this year, I figured that would hit gold and gold would drop as a result of that announcement. But actually, gold kept going up. So if I had stayed in, I could have made probably like 8% on my junior gold miners fund. I only walked away with about 3% on that one, but still a pretty good investment for me. Overall, a really good week for me. Most of my predictions came true. One loser for me was oil. I expected oil to drop on news of that crude inventory supply build, but instead it moved higher on dollar weakness and news of the Brexit deal. But fortunately, I saw what it was doing, and so I got out pretty quickly on that one to minimize my loss. And also a quick update on Eros, Robert. That's that Bollywood company that had signed a deal with Microsoft that we've talked about a few times on the podcast. It bottomed at 128, and then it jumped midweek. And by the end of the week, it was 176, which is a 37% gain. So really, really nice gain in that stock this week. And it's got some resistance right around this level at 176. So we could see a little bit of a drop, but I think it will ultimately move higher. And if and when it breaks out above $2, then it could go north to 260 very quickly. So pretty bullish on Eros. I'm going to be watching that one this week.
Man, you sound like a real stock analyst. I mean, or a day trader. You can live off this stuff.
Well, I'm not at the point where I'm making a living off of it yet, but, a little bit here and there.
Me, I'm just in it for the long haul. So for my stocks this week, so I was basically monitoring Activision Blizzard, and as many of you know, reports that the boycott on Activision Blizzard have shown that there has been some impact on Hearthstone, which is their one of their main PC mobile games. Sales have shown to be 20% lower than without the boycott, but other game data for larger titles like Overwatch series and World of Warcraft aren't available, so it's hard to see how deep that impact is for Activision Blizzard. It opened 1.5% down on pre-market at the beginning of the week, and it's still relatively flat overall for the entire week, so it hasn't really gone down, but it hasn't really gone up. And then Morgan Stanley and also Citigroup came out this week and also updated their price target for Activision Blizzard, and it caused a nice bump in the middle of the week, but overall at the end of the week it kind of flattened out and was about the same price that it was when the week started. Bank stocks dipped in early morning trading on Monday, but rallied higher prior to quarterly earnings released on Tuesday. 11 banks reported quarterly earnings Tuesday, as we mentioned earlier. Outside of Goldman Sachs and Wells Fargo, the other 9 banks' quarterly earnings beat estimates, but as we said earlier in the podcast that these estimates were already low to the point where they were still lower than last year's estimates, but they beat this year's estimates and we're still a little bit higher than last year, but not as good as what it should be in a good economy. And then bank stocks ended the week higher than the beginning of the week.
Talk to me about that the boycott. I'm not that familiar with that on Activision.
So there was a I think it was a Hong Kong player. It was either Hong Kong or just Chinese descent. A player who won the championship in Hearthstone, and Hearthstone is like a trading card game for Activision Blizzard. So they have basically Warcraft's graphics and characters, most of their IP, into a card game. And every year they have like a championship, standard esports division, and the player who won this year was a Chinese player. I think they might have been Hong Kong. I have to double check. But they, during their victory speech, when they were being interviewed by Blizzard's official Twitch channel, they announced their support of Hong Kong, which, with all that controversy right now between China and Hong Kong right now, with Hong Kong wanting to basically fight for more of their rights now that Hong Kong is being transitioned into mainland China in terms of that whole England's handing over Hong Kong back to China and it taking, I think that was like 20 years ago, and they essentially are supposed to inherit all the stuff from China in terms of like their rights and everything. And one of the biggest things that they're fighting for is their extradition rights. So a lot of Hong Kong citizens don't want to be extradited to mainland China if China tells Hong Kong that they need to be extradited out of that country so they can be prosecuted in China. So that is the main point that Hong Kong is fighting, and because of this, a lot of customers of Activision Blizzard or people in the video game industry see this as Activision Blizzard's voicing their support of mainland China and not supporting people's right to voice their opinion in a public manner, because as a result of the champion speaking out during their victory speech, they were punished by Activision Blizzard. They suspended their account for 1 year. They took away all their winnings. And because of this, there was a huge backlash in social media, big enough that they actually reduced his suspension to 6 months, which is still quite a long time, especially if you consider a lot of esports players' only income comes from, playing the game that they're playing. And they also did give back all his prize money, but after a huge amount of backlash, and there's still some backlash today, especially due to the fact that they still kept the suspension for 6 months instead of just completely getting rid of it. It got so bad that actually Congress sent a letter from a bipartisanship group out of Congress to Activision Blizzard, admonishing them for sending out for keeping the suspension on the player, and rather than just wiping it clean.
Wow. Yeah, I mean that's quite the overreaction by Activision there, but I guess they probably have a lot of ties to China, and China probably put a lot of pressure on them to do that, and they had to kind of signal that they were not going to alienate the Chinese market there.
Yeah, well, I mean that's the result of the economy now, is that there's so many companies that have deep ties now to China that they don't want to get banned in China, because if you get banned in China, you're basically getting rid of so much potential revenue for your company internationally, that a lot of companies like Vans, who are the other bigger ones? There's Vans, Disney, and a bunch of other companies essentially are just basically just preventing any sort of bad news with China. NBA, that was like the bigger one that came out around the same time as Activision Blizzard was the NBA. One of the coaches voiced their support of Hong Kong, and NBA was like, no, we don't.
Yeah. It's hard to know how to play something like this boycott because on the one hand, it's a blip, it's a one-time event, right? And so you could look at this as a buying opportunity if the stock dips on news of the boycott, because as soon as that boycott is over, as soon as people forget about it and the situation is resolved, Activision is going to return to normal. But the question is, when do you pull the trigger on buying in on that opportunity, right? Because the initial headlines of the boycott will cause the stock to drop, but also on the next earnings report, if it has had a significant impact on earnings, especially of Hearthstone, which is a major product for Activision, the stock could drop again on that earnings news, right? So it's hard to know exactly how to sort of grab the bottom on something like that. But it does seem to be a buying opportunity. And presumably in the long term, that stock should come back up as the situation normalizes.
Well, they also do have Call of Duty, which is one of the major franchises coming out next Friday, which is why I'm basically going to continue to watch Activision Blizzard. And then also BlizzCon, which is Blizzard's own convention for all their major titles. They announce big moves during these conventions. That will usually cause the stock price to either spike or dip, depending on how well the convention is received. Last year, it dipped because they announced Diablo, but for mobile, and their reaction to it was really bad because essentially a lot of people were disappointed because they were expecting a Diablo game for their computer, and they announced it for mobile, and a lot of PC gamers are totally against mobile devices. And so when they asked if there was the ability for players to play Diablo mobile on PC, the developers were quick to say no during the convention, and this caused the developers to say, and it's now a famous meme in the gaming community, is, don't you guys have phones?
I see. Well, yeah, I mean, the Call of Duty launch should buoy the stock a little bit, so this might be a good opportunity to buy in on that boycott dip.
Yep.
Cool. Well, what are your picks for next week, Robert?
I'm going to be looking at Tencent. Now, Tencent, this is a Chinese-based company that owns many subsidiaries, and one of those subsidiaries is Riot Games. Riot this week, Riot announced that they're going to be launching a few new titles. They're in development right now. Some of them are gonna take a little bit longer to bake than others, but Riot is known for their ultra successful League of Legends franchise. Now, for those that don't know, League of Legends is what's considered a MOBA. And in the gaming industry, MOBA is kind of like I wouldn't say it's a niche, but it spawned, it's basically its own genre within the last decade. It spawned from a modification from a Blizzard IP many moons ago. And then League of Legends was the first company to capitalize on this. And they've been basically capitalizing on that since day one. And even Blizzard's tried to get into the MOBA genre, and they failed. Like they literally shut down their esports division because they weren't able to be as successful as League of Legends. Like League of Legends has their own esports division that they support themselves. It's a worldwide phenomenon, and they're currently looking to disrupt the current leaders in the first-person shooter and the fighting game markets. So they're trying to show the gaming market that they're not a one-trick pony. And this will probably cause the stock to dip lower over the next coming weeks or maybe months, depending, because usually when companies announce new projects like this, investors typically sell on this news. So the stock's going to be a lot lower. So it's a good buying opportunity, because there's never a guarantee that the new ideas will bear fruit. And sometimes, new ideas, they don't come to fruition, kind of like how Blizzard tried to get into the MOBA genre and they weren't really successful at that. So I'm optimistic that Riot Games will do well with creating new IP. It's all a matter they do have a lot of cash on hand from their decade-long experience, or decade-long filling their coffers with League of Legends. So they definitely have the expendable cash to create new IP. So Tencent, their stock symbol is TCEHY. I'll definitely be monitoring that over the coming months. And then Ford is reporting earnings on Wednesday. And although overall sales are down, the average transaction prices were up. So Ford conducts a majority of its business in U.S., Europe, and China. And their China business is struggling mostly due to the fact that the products that they launch there aren't really designed for the Chinese market. So they've pretty much, like, their Chinese business is pretty much down 30% after pretty much collapsing in China. So they're actually revamping and relaunching 30 new or revamped models and in China. And so I'm looking forward to hearing the results of the third quarter. It's also probably a good buying opportunity because they do have a dividend especially for how cheap the stock is. It's like I think it's like $8 right now. And so they're kind of like my dark horse in terms of long-term stock because Ford's been around quite a while and they've been restructuring for the last year. Their last CFO left the company, I think, 6 months ago, and they're basically just trying to not necessarily right the ship, but actually prepare themselves to compete in the newer generations rather than just the status quo, kind of like how GM is doing.
Yeah, their CEO has an interesting vision. I actually bought some Ford earlier this year and made some money on it and then got out. But their CEO basically has this vision where autonomous cars are going to be the way of the future. And Ford is a little bit behind the game on autonomous cars, and it's a competitive market. So rather than focusing on developing autonomous cars, Ford has been focusing on developing the transportation infrastructure that will support that, networked roads and networked, stoplights and things like that. Which I think is an interesting way to look at it. I mean, it's kind of like the California gold rush where the real money wasn't in the gold. The real money was in selling groceries and tools and stuff to the gold miners. Ford is kind of trying to position itself like that in the self-driving car market. It's been doing a lot of kind of redesign and innovation. I think you're right. I think Ford has been at sort of unprecedented low levels. It's been a failing business for the past 15, 20 years, but it could turn things around. So it's very possibly could reposition itself to be a winner in this market.
Yeah, and the last stock I'm looking at is Nokia. Now, traditionally, a lot of people know Nokia for their indestructible, invulnerable, Superman-like phone or old green screen phone that you could throw against the wall and it just still works. I'm pretty sure if you have one still and you can actually just charge it and turn it on and it should still work.
The brick phone.
Yeah, the brick phone. They've been transitioning over to infrastructure, especially in the 5G market, which is the next generation of internet connectivity for your wireless device. So a lot of optimism with analysts with Nokia right now. So that's one stock I've been watching right now.
I thought you were going to say they were transitioning from brick phones to flip phones. All right. Well, the stocks that I'm watching are Eros, which we already talked about. I'm really interested to see whether this starts to dip on Monday or whether it just keeps surging up through that resistance in the around 180. That would be exciting for me to see it break through this quickly, but I suspect that we'll see a little bit of a dip before we see it move higher. I've also got Taiwan Semiconductor. So Taiwan Semiconductor is a chip company, computer chip company. It's an extremely good value. It had extremely strong earnings this last week, but it pulled back on earnings day because it just had gotten too far ahead of itself. And so it's going to dip and then it's going to bounce. And the question is, where will it bounce? So I've drawn a bunch of trend lines and I've identified some support levels. And basically, just as soon as it breaks my trend line and starts to move back up, I'm going to buy it. So, pretty excited about that stock. That stock has been in a really long-term uptrend, and I see this. The earnings report is kind of green light for it to move higher, but it's going to make a dip first, which is a nice opportunity to buy in. So, definitely watching that one.
That
I've also
dead
got
cat
alerts.
bounce.
Say that again.
The dead cat bounce.
Well, that's I think the dead cat bounce is when it doesn't keep going up, right? It goes back down again.
No,
Bounces and then it
it's especially when a stock is tanking, and but it sometimes does small corrections over time, but it basically it's like the stock is dead, but it upticks for a little bit as people are buying in because they think it's gonna skyrocket at some point. And so that causes the stock to go up just a little bit, like a dead cat,
Well,
like a dead cat would bounce off the ground.
this is more like a live cat falling off the counter. This one's been in a long-term uptrend, and I think that the uptrend will continue. It's a good value, this stock. I've also got alerts on Pinterest, Exelixis, which is a biotech company, and American Eagle Outfitters. These are all stocks that have been in long-term downtrends. So they look pretty undervalued right now. Their analyst ratings, though, have been increasing. They've got rising volume, especially Pinterest. The volume in Pinterest has been increasing. So it seems like investors are getting more interested in these stocks, and analyst ratings on them have been going up. So I've got trend lines drawn on these, and I've got alerts on my trend lines to buy in when they start to break their downtrend and head into an uptrend. So, and then here's one that you might like, Robert. Kinder Morgan reported its earnings this last week. It's a natural gas company. The earnings were a little bit under analyst expectations, so pulled back slightly. But the overall fundamentals of this company look good. It's growing. It's reducing its debt. I think they said that they're making progress on their project pipeline. They've got like $6 billion worth of natural gas projects in development, and they have made progress on that pipeline. They reduced their pipeline by $1.6 billion by completing a bunch of projects, and they expect a 6 times return on all the projects in that pipeline. So if you figure, I actually think it was like $4.5 billion worth of projects that they have in the works, but multiply that by 6 for the return on those projects. So long term, they're well positioned to keep growing into the future. They've been increasing their earnings. They increased their dividend this year to 5%. Their dividend is sustainable, which is a really important thing to pay attention to with dividends. Is like, are they paying out more in their dividend than their earnings actually support? Which tells you that the dividend is likely to decrease in the future. That's not the case with them. They should be able to sustain their dividend for a long time to come. So it's a growing company with a great dividend, and company executives, insiders, have been buying up shares in the $18 to $20 price range. It's about 20 right now. So if it gets down a little bit, a dollar or two into the 18 to 19 range, it'd be a really good buy because those insiders seem to be really optimistic about the stock, and their purchases in that price range are going to help keep the stock above that price. So, I mean, you figure if you buy the stock at $20 and then hold it for 20 years, you've made your money back with a 5% dividend, right? So, plus then you can sell the stock and get the purchase price back as well. So this is a really nice way to do a dividend investment, I think.
Yeah, and definitely looking at their overall chart from the last decade, and if they hit back at that number that they hit in May, right before it tanked in December, that would be nice. $43 before it tanked down to 13 within the span of 6 months. So that's and that's not even during a period of recession, is it?
I don't know, but natural gas companies do their own thing because they're really more tied to natural gas prices than they are to the overall market. So you got to really look at natural gas futures. What are natural gas prices likely to do in the next 20 years or so? I haven't really done that research, so I would recommend if you want to buy Kinder Morgan, you go read up on the Energy Information Administration website, the EIA.gov. They have newsletters and reports on future natural gas prices. So they can let you know sort of what natural gas prices are likely to do, in 10, 20 years. Um, Now, I did notice on reading the earnings report for this one that in their accounting, where they're predicting, 6 times return on their project pipeline, they're assuming a natural gas price that's well above the current market price. So, if prices stay weak like they are right now, then this company might not realize the kind of revenue that they're expecting. But on the other hand, natural gas prices go through seasonal cycles, and we're in kind of like a dip point right now on the seasonal cycle. Usually, natural gas prices actually rally a little bit later in the year, like around April. So, buying now wouldn't be a bad idea in terms of where we are in the seasonal cycles for natural gas prices.
Yeah, as long as their stock doesn't dip down to that $13 level, I mean, as long as you hold it long enough, the interest from the dividends would pay for any losses if it did stay relatively flat or dipped a little bit.
Right. That is the nice thing about dividend stocks is that they eventually pay for themselves as long as the company doesn't significantly reduce its dividend. And this company is healthy enough and has enough cash on hand that I think like I said, I think their dividend is sustainable and it will stay at the current level. The other thing about this stock is in their earnings report, they specifically said that they've got enough cash, they'll be able to pay for all of their products with cash. And so they won't need to take on new debt or issue new share offerings, which is one of the major drags on stocks. When stocks issue new share offerings or when they take on new debt, that's one of the major like warning signs that investors look for to exit the stock. So the fact that this company very specifically said they're not going to do that means that a lot of the risk is removed from this stock. So you shouldn't see those big dips unless maybe natural gas prices suddenly collapse overnight.
It's definitely one I'll be keeping my eye on now.
Yeah, I thought you'd like that one. All right, Robert, anything else to add before we close out for the week?
No, I think we got everything. Yeah, is there
Everybody,
anything?
thank you so much for listening. Your listenership keeps this podcast alive. Please, share our podcast with your friends on Twitter, on Facebook. If you heard something that you liked, give us a little tweet or a link. And if you should click on our Webull link and open up a Webull account, we'll get a little free stock that'll help us keep the podcast alive, maybe buy some new equipment, improve the quality of our recordings. Also, like and share the video on YouTube. Give us a subscribe on YouTube. And we're also going to release this on Podbean and iTunes, so if you could give us an iTunes review, that'd be great. That helps a lot too, increase interest in the podcast. Thanks again, everybody, and we will catch you next week at the zoo.